Welcome to this breakaway session. I started the Technical Trader back in the early 90s. Started trading in the 80s. I'm glad to see the session's named after my business, the Technical Trader. Not sure quite why that is, but it's good to see. This speech was originally given in Singapore, hence the Chinese version of my book, The Way to Trade. So we'll switch to the English version, The Way to Trade. I wrote the book back in the late 90s. The Financial Times commissioned the book at the time, and at the time I was concerned about traders discovering their successful trading personality, which was a focus of the book. It was well received, people enjoyed reading it, they tell me. So if you haven't read it, then I recommend you try it out. But it's become quite clear since I wrote that book that discovering your successful trading personality is one thing, but making trading into a successful business is something entirely different. And there are actually 5 pillars to trading success. The first is your trading focus, which means the markets that you choose to trade and the way in which you trade them. Then your trading style, which is really bringing your own personality into the trading of the markets that you choose. Having got to that point, then it's a question of getting the trading right. So you're actually trading in a correct format, making as many points as you can from the style and the focus. The next critical step is size. Size is very important in the markets. If you're not trading in the right size, it'll never be a good business. And you'll be spending a lot of time really just spinning your wheels, making a few pounds here maybe, but not actually making a living income, not getting yourself financial freedom, and size is really absolutely critical. Once you've got that in place, it needs to become a habit, so you're trading successfully, all these various components in harmony, making money successfully in the right size, so you do have that financial freedom. So I'm now writing The Way to Trade 2, which is all about these subjects, about making your trading into a successful business. I will later be talking briefly about the markets in 2014. This speech took 20 minutes to deliver in Singapore, but I'm condensing it so it'll only be a few minutes. Zach, we're looking a bit concerned there. So there are 2 distinct, this is why it's called trading as a business, because this is what it's all about. You know, it is a business. I mean, some people do say, why do you do other things but other than trade? They say, well, they need to be surprised that I'm giving seminars, we're selling books. But once you realise that trading is a business, I mean, do you ask Apple, why did they bother to design the iPad? I mean, they're selling computers successfully, why they bother with the iPad? Because it's a business. Business is all about expanding it, making it bigger and better. And people keep asking traders, why do you do this? Why do you do that? It's a business. I mean, you either understand business, understand the business mentality, or you don't. And if you don't understand it, then you ask the question, in my opinion. Anyway, there are 2 distinct aspects to this about making money: the markets themselves and you. You cannot control the markets, but you can control yourselves. It's not always easy to do so. But what you do in 2014 is far more important than what the markets do in 2014. We run a course called Pro Trader. It's all about taking individuals who want to trade professionally and developing those skills so they can do that. And I'm just going to show you 2 trades that one of our traders did, because to me it just perfectly illustrates what I'm talking about and making trading into a business. This is the IG Index trade sheet. So you can see that I've lost the microphone. £500 a point. The key points here: they bought at £500 a point. The time, 15th of January, 8:11. He then closed the trade, 8:14, 3 minutes later, a £5,000 profit on that trade. Now, I'm not saying we should all trade at £500 a point, because it would drive many of us mad, I think. But that to me is trading as a business, and that illustrates the point I'm trying to make. A lot of people spend hours on the markets, doing very little. But with the right size, the right focus, it becomes you can become financially free and have a very successful business. And that's a key point that nobody really ever makes, I don't think. I haven't heard anybody else saying that in the past. but it's absolutely critical. That's where the business is, and you're either in business or you're not. I mean, nothing wrong with being a hobby trader. We all have hobbies, or mainly. I mean, skydiving's a hobby, which I would consider far too risky, but it's something that people enjoy. Mountain climbing, again, people die doing it. Trading can kill you financially, but it's all about what you want from the markets. So £5,000, 3 minutes, cover that. Clearly there's a lot of preparation in a trade like this. I'm not saying that it's all over in 3 minutes. There's a lot of building up to that kind of trade. You've had to put the work in. I mean, every business you go into, you've got to put the work in. You obviously need an account size to justify that kind of trading size. This is actually the 1 minute chart, IG chart of the trade. You can notice the little spike here. If you read the way to trade, or indeed binary trading, that was a spike. It then went sideways, and then he bought when it started to go up, and it's over in 3 minutes. It wasn't looking for many points, he just wanted 10 points. You don't need many points, obviously. And it's just a very different focus. There's a purity about it, which I think is quite inspiring. And because I tend to be a longer term, I'm more of a longer term trader, so I'm looking for trades with, say, 40, 50, 100 points, that kind of thing. But you don't need that kind of thing if you've got size. I mean, it's a question of balance. It's a question of what is right for you. But I just like that example. So let's say that the Pro Trader course is about making professional traders. We define it as making £10,000 a month. There's a step-by-step process. We don't expect everybody to succeed. I mean, in life, it's just one of those things. You can't force traders to become successful, but we have a number of people doing very well, and we're happy with the progress we're making. It's only 4 months old, in fact, so it's quite early days. Right. I'll do quickly onto the markets. First, I'll look at the calls I made at this time last year. It was actually the beginning of 2013. Buy Japan. So we bought Japan just about 10,000. At the beginning of this year, I said get out above 16,000, which it just blipped up. This chart says it's now come down here somewhere, in fact. So that was the first call I made last year. Secondly, I wrote a book actually called Trading Triangles about the call on the pound dollar, and it came crashing down. So both those calls worked out quite well. And the book is here. If you'd like a free copy of the book, just email that address and you'll get a free copy of the book. It does cost me money, I would say, so it's free for you, but it's not free for me. So here's your chance to bankrupt me if you buy enough copies of the book. Anyway, it's triangles@aweber.com. That's an automated system. You just send the email through, get an email back asking you to click a link, which just is double opt-in. It just avoids spam. Right, 2014 calls. Sell the Dow. Looks very toppy to me. It's bouncing around the 16,000 level, and I think there's a good case that we're going to see the markets pull back. They fell back last week a bit. I mean, they've been going up and down around that level, so I think we're in a topping process. These topping processes can continue for a while, but that's one call. I've almost finished now, Zach. UK's got a kind of strange pattern. You've got this 5 wave down. I use Elliott wave theory a lot. Then there's just this continuing sort of diagonal type thing. Again, we've got a case that we're going to come down. I think the Dow's a stronger case at the moment, but FTSE certainly possible as well. That's a shorter term chart. And buy gold. I think gold certainly. I'm long gold, and it certainly has built a decent base. I'm just nibbling away at the moment because it's trying to rally. It could just be an ABC. It could just go up to the previous. I think it's the 1400 thereabouts. Well, I can't remember. Anyway, there's but we are due a rally above the previous high. It's what happens then that I think is going to be pretty critical. There's this big triangle on the euro dollar. It looks like it may want to go up here, but it looks like a sell longer term. But right now the triangle's worth watching, but no more than that. Right, that concludes the presentation. We're going to have sort of short Q&A sessions after each presentation. So anyone has any questions, please ask away. If not, I'll let... who's coming on next? Okay. Cameron's my trading partner. I have Cameron and Mark Austin, we trade together.
The trader who's aiming to make $1 million in 2014, what's his starting account size?
I don't know precisely, but it's certainly 6 figures. No.
Do you use fundamental analysis with your trading?
No. I mean, I'm not saying you shouldn't do it. It's a personal choice. It's part of your focus. But I tend to use shorter-term entry systems looking for longer-term trades. I mean, the chart I showed you, the 1 minute chart of the Dow is a sort of typical kind of entry I might take. We have got this 1 minute spike, and then it just goes a bit higher. And if that was tied in with some longer-term analysis, then that would suit me.
How does automated high-frequency trading affect the market?
I would say not at all. I would say the market's always been like that. I mean, the only thing that's a constant in the market is change. So it never really changes because it's always changing. I mean, it is constant. So I don't. I mean, that's just the way it is. I don't tend to worry about that kind of stuff. I mean, I think that there seems to be a case being made that there's an unfair advantage, which is something else. But in a way, there have always been unfair advantages. It's just a question of, the unfair advantage perhaps moves on to the next, it gets closed down and it goes to the next one, and I think that's the nature of life almost. It's, I mean, it's not ideal, but it's you have to live with the way things are.
Okay, we better go into Cameron.
Okay.
We'll be,
Thank you very much.
Good afternoon, everyone. So Zach promised me 15 minutes. It doesn't look like I'm going to get it today. 10. Okay, well, anyone that knows me knows I can't actually say hello in 10 minutes. So talking about short-term trading, although short-term is 10 minutes, generally my trades are 10 minutes. When I talk, it's normally for hours. So I'm going to attempt to tell you as much about short-term trading as I can in the time we have. So I am a short-term trader of the Dow Jones and FTSE index. So I don't buy any stocks. I trade on the price of the market, either with a CFD, a spread bet, or you could trade on the futures. Typically, my trades are all said and done within the first hour of trading. 90 minutes is maximum for me. I haven't actually always been a financial trader. I've had many years in business. I started my first business when I was 20, and many multi-million-pound businesses. But I found in business that you just had so many things that were just hassles, like offices and staff, employment law, cash flow, and so on, that you have to go through things that you don't like to find out what you do like. So I found that in the markets, I could really do what I was best at in the purest way. So after many years of trading in the markets, I really believe it is probably the best business that you could ever have, because you have no staff. I can trade from anywhere in the world. I don't have any major cash flow issues. And actually the investment that you have to put into trading compared to the return that you can have out of trading is small, very, very small in comparison to what you would have to put into a big business to get the kind of returns that you can get out of a business. Also, you're liquid. I mean, I'm a day trader, so by the time I finish every day, of course, everything's back into my account, I'm liquid every evening. There's very few businesses that you could say you're in liquid in. Taking many years sometimes to get your money out of the actual business. So, can you really make money day trading? And you hear lots of people say no. Can you even make money out of the market trading for 1 hour? So I'm here to say absolutely you can. Can you make money from small time frames, 5-minute charts, 1-minute charts? Well, you've seen the example from John, but if I go onto any of the forums, people will say a 5-minute chart is just too small. It's too small a time frame. It's too much noise there. I really don't believe that. Actually, it's really about price. It's about understanding price in the market and to be able to execute on price and having a clear edge. It doesn't matter if it's a 10-hour chart, it's a 4-hour chart, 1-hour chart. It's all price. It doesn't really matter. But if you can understand that price and take an advantage and have an edge on the price, then you can make some money on a 1-minute chart. You can even make money on a tick chart. It doesn't really matter. So having an edge. So you need a solid trading methodology. Myself, I trade gaps. I trade breakouts in the market. You need to understand market function. There's certain things that will happen in the market time after time that really pretty much have to happen. Gaps are one example of that. understanding institutional trader psychology. The market moves because of the large institutes. The retail traders don't really move the market. So if you can get into the psyche, understand what those institutional traders are doing, you can get on the back of their trades and take advantage of that. Understanding historical probability is it's not everything, but it is key for me as well. Understanding that a certain trade or certain setup has a higher probability, and what is that probability, so you can leverage up on certain trades. Certain trades I have that sit at 90% over many, many years. So those trades I'll leverage up high on. Understanding price action, but most importantly is really understanding how your trading plan is acting out or playing out in the market. Because you can have a trading plan, but if you can't then, like, you could decide to drive from Edinburgh to London, but if you don't realise that there's a massive big truck in the way en route, you know, you're going to have a problem because you thought you were going to travel at 70 miles an hour all the way. The road's not clear, so you really need to watch the market. How is it all playing out according to your plan? If it's not playing out according to your plan, cut the trade. And that's really something that people forget. They focus a lot on their setup rather than how their trade is actually playing out. So these days I trade myself. I run a service called Excelsior. It's actually been going since 2012, but in the last year it pulled in 54%, has a 70% success rate. We're up, I mean, that's on a small account. You can see the pips are up about 1,400 pips. I don't really bother about pips, it's all about return. And if you were trading a 10 grand account, you'd be up about over 25,000. I realized that people need more than that, more than an alert service, and I run courses, but after the course I do a live trading room where I've had people in for 30 days, but then realized that people need ongoing support. I do that with John as well through Pro Trader. And started that back in October, so that has achieved 121%, 72% hit rate just in the last, just on 6 months now. So can you achieve, well, short-term trading? Absolutely. Why short-term trading? Well, short periods of exposure in the market, nobody knows. All these guys are experts, but they can't tell, including myself, can't tell you where the market's going to open on Monday. So the shorter you're in the thing, for myself, that's a lot better. Having a high hit rate, something like 70%, it gives you confidence that you can go back to your trades. When you've got a low hit rate, big rewards, it doesn't certainly work for me. No major screen time watching, so you're trading for 60 minutes, 90 minutes max. You'll see in a minute I trade for about 20 minutes. Also, why would you want to be at the screen for too long? If you can be done in 20 minutes, 30 minutes, an hour in the day, why would you want to sit there all day? I have a very nice sleep at night. I don't have any positions in the market overnight, so I can sleep, I can rest. It's something else people find, or you might find, it's hard to hold positions for a long period of time while you're in the market. Also, I know exactly when I'm going to trade. I trade at the open every day, so I can plan my whole day around my trading. And I know I'm going to be there for about an hour, 2 hours, that's it. So I thought rather than cherry pick all the best trades, I would just take this week's trades that I launched for the service and show you exactly the email as they went out and what I posted. So I'll take this mic here. So we took 4 trades this week. I'll just talk through them really quickly. Zach, how long have I got? 5 minutes? 2 minutes, right. Okay, so what I want to really highlight is that I'm posting these before they happen. So at 2:37, I've posted an entry here. We're entered in there. The target is there, 15 minutes. The trade is done, 1% on that trade. Then 22nd, same thing. You can see the email went out where the entry is here. Target, 20-minute trade. Another 1%. Wednesday, entry here. Email you can see, target, bit longer, 35 minutes. Threw a curveball on Thursday, and I decided to trade the NASDAQ. I normally trade the Dow. I hardly ever trade the NASDAQ, but it was just such a good position on it. So I posted that out at 220, told people pretty much to get in at market at 18 or higher, and 11 minutes later, hit target 1.64%. So nice week. Actually, I didn't trade the service on Friday. We traded in the room. But the service for the week, 5%. I thought I'd throw in a few of my extra trades that I took on the FTSE just this week and one last week. And you can see I'm just going for 9 points, 8 points, 9 points. I threw these in because this is interesting. I've taken about 140 points. I'm a short-term trader. I'd look for 9 points, 10 points in the FTSE, 20 points, 30 points in the Dow. But I took these trades, they're not throwaway trades to be flippant, but they're not high stakes trades. But you can see it's pulled in about 1,700 quid just last couple of weeks. The reason I took these trades is I often see in the market or see retail traders getting anxious and thinking the market's going to collapse. As soon as people get really, really bearish, I get bullish. So I bought this. The market was down about 120 points and everybody was getting short. So I thought I'm going to get long on this. I got long from a technical position and took 120 points out of it. And I'll do that over and over again. I took this one here, it was 40 points as well. But it just reminds me, I take these trades not so much for the money, just to keep reminding me that not to follow the herd. Because if you follow the herd, you're going to step in something. You're going to have to watch what you step in. Because really, that's where all the money's coming from. The 95% of people that are going, that the market is now falling apart when it's not, where the smart money is going long. So those are some of the trades. Just finally, Zach, there's a book that Mark, John, and myself wrote, Little Book of Trading Secrets, totally free. You go to magnetictrading.com, just put your details in there, you'll get that. There's a trade in there that's made 63%. It's one trade once a month. It takes 10 minutes, and that's it. So I'll take any quick questions. Yes.
You mentioned about institutions. Can you give us an example or just expand on that a little bit more?
Yeah, I mean, just a quick example is there might be profit taking at certain times of the month. There might be buying at certain times of the month. Perhaps, say, for example, the beginning of the month, institutes put new funds into the market. It's more likely the market will go up on a day like that. Okay. Yes?
Do you use any indicators or just?
No, I don't. No, I don't use. I do trade. I have EMAs on my chart, and they're more for just seeing what's happening. I don't trade off them, but they give me a guidance as I'm trading. Yeah.
When you say 5%, what's that 5% of? It's up
5% of your trading account. So whatever your.
10,000.
So if your trading account was 10,000, yeah, you'd be up 500 quid. If your trading account was 100,000, you'd be up 5,000. Yeah.
You're saying that you are paid for 9, 10 ticks of profit?
For the FTSE, and then about 20 to 30 in the Dow.
What about the spread? Is it a net tick profit?
Yeah, I mean, I kind of just work off the mid price. So if it's 10 ticks, it's 10 ticks on the chart minus your spread, 9 ticks. Yeah.
Okay, shall we go into the next
Correct.
presentation? What's this page?
Hi everyone, my name is Maria Psara. I had an advisory trading desk at NF Capital. I'll keep it very short. I wasn't going to give a speech today. I'll give you a bit of a background of who I am. I have been trading for quite a few years. I started at what was then big proprietary trading desks, where we were trading for the company and for institutional clients, and after some point ourselves too. And from then on moved into advisory trading, which is what I do now at NF Capital, where I advise clients on really how to invest, how to trade. We do specialize in short-term trading, I would say, relatively. So it would be short-term stocks and then short-term indices such as the S&P 500 or the FTSE. And now, what I do these days is, as I said, give advice to my clients and hopefully help my clients learn a bit about how to then select trades themselves and how to avoid making mistakes that I have learned, we all have done, at least I have done in the past, and mistakes that I see other traders making or other clients making. So this is my role today, giving advice to clients. It is on a non-discretionary capacity, so we always give control to our clients as to what their final decision will be. I agree with many of the things that I've heard earlier. I think good trading takes time to learn, and everyone is different, so it's a personality thing as well. So I agree with the things that the two gentlemen said earlier. I wouldn't like to add anything at this point. If you'd like to ask me something, by all means. Yes?
Short-term trading means different things to different people.
Of course, yes.
What is your idea of short-term?
My idea of short-term, if we are looking at it in individual equities, would be anything from a couple of weeks to a few months. If it is a news trade, a company is reporting tomorrow, we may even buy today or sell today, go short today, and exit tomorrow if it's a profitable trade. Then if we're looking at an index, short term, I would say, can be a few hours or even less than an hour. So that I would say short term. Yes.
Technical trading to help you decide what's best?
Yes, I use a combination of things. I use, when it is individual equities, I do look at fundamentals. So I will not buy into a stock if I don't like the company's fundamentals. But at the same time, I will not only use fundamentals and go in at any given price. So at that point, yes, I will use technical analysis. I will look at support resistance. I will wait for the stock to pull back, if I'm going long, if I'm buying, to pull back to a level where I can get a better price, and then on enter at this level. I don't use too many technical indicators. I'd say quite few, only the relative strength index, maybe a moving average, but that's about it. So it is a combination of the two, really.
Have you got a website?
Yes, of course. The website is jnfcapital.com. jnfcapital, all one word, .com. The company is called JNF Capital. So J for Juliet and N for November, F for Fox, and then Capital, all one word.
I thought Zak is also involved with it.
He is correct. He is our chief market strategist.
I try to keep that quiet.
Well, I didn't, unfortunately.
Thank you, Maria.
Okay, thank you all very much.
Good afternoon, everyone. I used to clean toilets, at which point you're probably wondering, either you're all in the wrong room or I am. I went from cleaning toilets to, 20 years later, having a hedge fund. Which probably makes you wonder, how easy is it to set up hedge funds, and do they let anybody do it? The area that I'm going to speak from is our perspective as an institution. Our minimum accounts are institutional investors only, because the minimum account size is $1 million. So how do you go from just trading on your own account as a private investor to building up an institution, a regulated entity which runs money for pension funds and the like? And more importantly, more relevant for you, is what do we see happening in the markets at the moment? I won't talk any more about cleaning toilets, although I can guarantee you that I am by far better than anybody in this room at cleaning toilets. But I'm sure you don't want me to prove it. But I will talk to you about the markets, obviously. So are we overvalued, or are there opportunities? And where are the opportunities? Let's start off with the case for overvaluation. And before I do that, I want to address the question the gentleman asked about what does short-term trading mean. I was at a talk recently where I was talking about short-term trading, and this elderly gentleman came up to me at the end of it and said, "Son, for me, short-term trading is just being able to trade tomorrow morning." So I completely take your point. Yes, absolutely. Our definitions, maybe not minute by minute, but certainly our definitions, and I'll try and be very clear on some of these definitions, starting with, on the case of overvaluation, let's look at price earnings. Many of you will be familiar with valuing something according to price earnings. If you look at the US market at the moment, there's only been 3 times in their history that they've had a price earnings ratio above 25, the broader market taken as a whole. And that means the price of the index against the combined earnings of the companies which constitute the index. Those 3 occasions, ominously, were 1929, 2000, and 2007. If you know your market history, you'll know good things didn't happen to the markets around those times. The other time, the 4th time, is now. This doesn't mean I'm necessarily bearish, although, of course, as I've explained, I have a career to fall back on, so maybe I'm not so worried. But we are overvalued on that perspective at the moment. We are at 2007 levels on the FTSE 100 at the moment, but the UK market, whilst it's at those levels, the economy has yet to hit per capita income levels, in other words, your wages, that you had in 2007 in real terms. So there's clearly a disparity between what the stock market's pricing in and what we, who fuel the stock market through what we buy and what we sell and so on, we as consumers are able to produce. It's another case for arguing overvaluation. I've always found that the critical test to determine whether or not the market's overvalued, however, is to take a taxi ride in London. The moment the taxi driver starts giving you stock tips, the market's peaked. And this happened extensively in 2000. You might think, well, that's not a very scientific way. You run a hedge fund, and we're somewhat worried. For your investors now, that's the method you use. Of course, it's slightly tongue-in-cheek, but it is true. And I think it was the famous JP Morgan who said he knew the top of the market had been reached when the bellboy in the lift told him which stocks he ought to be buying. We haven't reached that case yet with taxi drivers in London. Are there any taxi drivers in the audience? Usually, of course, incredibly well-informed individuals. The other test is TV shows. Once we start getting prime-time TV shows on ITV around 7, 8 o'clock about the stock market, you know it's peaked. We haven't yet reached that. There is a more important statistical method to determine value of stocks, and that's you take the market cap of all the companies in a major index, like the S&P, you divide it by the GDP, the economic output of the country. Divide one by the other. At the moment, that ratio would tell you that we're at the highest level we've been since 2000. In fact, we've only been at this level once in about the last 20 odd years, and that was in 2000 before the market fell off. We're not at a bubble yet. The great thing about bandwagons is there's no problems getting on the back of one as long as you remember to jump off before it falls off a cliff. So we might be getting a well-valued market turning into an overvalued market, and that's fine, into a momentum-driven as opposed to a value-driven market, and that's fine. But this is not a good time to turn into a long-term investor, I don't believe, which is just as well because we're all here as short-term traders. My own background, as I said, setting up the hedge fund, it was in the same year the FT had a competition to predict the level of the FTSE 100. It was a competition which was run over a 12-month period, and I won that and came within 0.5% of the final value. That was largely based on technicals. So the issue is, therefore, okay, well, what do you think, using that same analysis, do you think is going to happen with the market? I put that analysis into a piece of software. The stocks which came up this morning from that piece of software, which we've been running since I won that competition 10 odd years ago, each year, just so you've got some idea of the track record of the performance, before I give you the stock names, it generated a 353% return over the last 10 years. It's independently verified by ShareScope, who've won for the last 11 years FT awards for best investment software. The nearest fund manager in the UK, picking the same British stocks, was only up 250%. So it outperformed every single fund manager that you all pay lots of money to, who are usually, and I think the panel will probably agree, pretty useless at what they do because they end up just tracking an index, which you're far better off doing usually, or just picking your own stocks. It also beat Warren Buffett, who was only up about 90%, so 350% against the 90%. So the stocks, just to establish the credentials of the method in which the stocks are picked, the names, therefore, which came up as of this morning, so I do believe there are opportunities in the markets. I just don't think long-term index tracking is the way you want to go for the next 2 years. So these are the ones which came up. GVC, Henry Boot. This is all based on data mining, specific individual fundamental criteria. I know it's a technical talk, but there is some elements of technicals when this data is analyzed. Charles Taylor, Clark T, Centaur, Interquest, Next 15, Bruin Dolphin, and National Express. Those based on exactly the same criteria which won those competitions and outperformed. Whilst we also are in a market where Barclays is at its 1996 levels, so imagine that, the sum total of banking and financial expertise which works at the top echelons of one of the largest, supposedly best banks in the world, have not been able, despite directing singularly their individual efforts at being able to increase their shareholder capital a single iota in the last 18 years. And they get to sack the lower employees lower down the chain. Anyway, Barclays is at 1996 level, BT is at 1998 level, and British Airways, as it used to be called, is at 1994 levels. That's not a criticism of the lack of talent in British management. It's more a comment that do not go for the big names just because they're at relatively low levels. The names that I mentioned you beforehand, which have been data mined, are probably companies you've never heard of. I hadn't heard of half of them. I hadn't heard of Interquest before, or Next 15, before I ran the algo this morning. So what I would say to you, and by the way, we're at 1999 levels on the FTSE 100. I would say to you, it's about to become a stock pickers market rather than one where you could just simply follow the index. It's about to switch into that because we're about to get into overvaluation territory. Whenever that happens, you want to be picking individual stocks and not worry too much if you pick good quality equities, or of course, we can talk separately about FX trading. I do not think, in closing, I do not think we're at a similar scenario that we were with the tech bubble. And the reason for that is this. I'll just give you one example. Groupon took 2 years to get from zero to $1 billion in revenue. eBay and Amazon and Google took about 5 to 7 years. Actual revenues. And $1 billion plus. Around the time of the tech bubble, it's not what we had. What we were talking about is they took from 0 to 2 years to get to 1 million users. And who cares how many users you've got? So what's different this time is it is not technology driven. It's a far broader, if anything, and it does become a bubble, it's far broader. The good thing about that is that we've got more choice of companies which are actually generating real revenues. We'll have more opportunities to pick those individual equities. So do not be fooled into people thinking we've got another tech bubble. It's not as bad as that, but equally I've argued why there is some degree of overvaluation. The rest I'll answer on the panel. I apologise for my voice. I'm actually on antibiotics and got out of my deathbed to do this. Life's been tough since giving up cleaning toilets. Thank you very much.
Okay, there's not much time left. I'm going to run through the questions I prepared, difficult questions allegedly I prepared for the panel, and maybe 2 or 3 sentences each. I'd like to cover them all, but whoever likes the question, feel free to go to have a crack at it. First one: what makes a good trader? Is it just about money in the bank? Are there any psychological or any other aspects?
Money in the bank is pretty critical. I mean, you can't really be a good trader without money in the bank. In fact, you can't trade without money in the bank. So unless you've got money to put down as a deposit, you can't begin to trade anyway.
Evidence of being a good trader.
Yeah, I mean, this is profits are what ultimately the ultimate test. I mean, that's what you're doing. I mean, you can be a good trader and make a loss. I mean, a good trader will limit the loss, but you know, we all make losses. That's inevitable. But you have to make money overall to be a good trader.
Okay.
Yeah, sure. I think, you know, obviously you need to be able to take risk. Having a sort of entrepreneurial spirit, it really does help to make a good trader, and not being too attached to it. The guys that we see that do really, really well are often not, they've maybe already made a bit of money and they're not so attached to the market.
I think it's also about it's a lot about your own personality, about the trader's personality. So I think a good trader is relatively flexible. Good traders are not afraid to change their views if the market proves them wrong. So it's not about being stubborn. So I'd say this is one thing. It is certainly about money. And it is a proof about whether what we think and what we trade is right. But I'd say the psychological makeup of traders and that side of things affects very, very much so whether someone can be a good trader.
I forgot to plug my book. It came out at the same time as John's, The Mind of a Trader. And in that, I addressed what helps making a good trader, and it's 2 things came to mind from that book. One is it helps to be psychotic. There's ample research which shows that psychotic people have sort of an emotional gene missing, which allows them to be very disciplined and cut losses. Might screw up the rest of their lives, but hey, you'll be good at trading. I'm not saying John's psychotic, I don't know the other panel members, but it does actually help. And I mentioned this in a serious note. I used to write a weekly column for the FT, and I take all the research from universities and put that into sort of plain English in the column. And one of the pieces of research actually showed this, that the best traders tend to be a little bit crazy. The other thing, I'm a Hindu, and it helped, and we strongly believe in detachment. The irony about being a good trader is it helps if you're detached from your rewards. You might think, oh great, well what's the point? What a catch-22 that is. You get the money and then you've got to get it only by not being bothered about it. Sadly, yeah, that's God's little trick he plays on you. It is true, without getting all David Cameron religious on you this afternoon, yeah, it'll help. I'm not saying you should all convert to become better traders by any means. We've got enough Hindus in the world. But yeah, detachment, just to underline that. Psychotic detachment will help.
Well, actually, the next question is one of my favourite. What makes for a good trading guru? How do you sort out the wheat from the chaff? Because it is a big problem that, you know, there's so many people out there who say that they can teach you, they can change you, they can transform you. What are the telltale signs of a good one?
It's really who you can work with, I think. I mean, obviously there are people who know what they're doing and people who don't know what they're doing, but ultimately you'll find somebody who you can work with and can help you. And that's not always going to be the same. I mean, yeah, the best traders may not be the best people to help you become a good trader yourself.
Yeah, I mean, yeah, good loincloth is helpful for a guru. I think my experience is learning from traders is if you find a trader is very intuitive, an intuitive trader is very, very difficult to learn from. Someone that's slightly more or has a mechanical process to go into their intuitive trades, it's a lot easier to learn.
Yes, I agree that it depends on who you can work with and who you can learn from better. But I also think it has to do. I think good gurus, same as good traders, are not afraid to say I was wrong when they are.
Two quick answers to that. One is obviously the serious one, which is track record. If you're willing to put your head on the block and you keep winning publicly, that's one thing. The flippant answer would be, look at the quality of their tan. I mean, John has got to be a good guru. Because just look at the quality. He's darker than I am. He clearly can afford, through trading, to travel the world. And I think that's the other, I mean, no offence to the more paler people on the panel. But, you know, I think John wins it on this one.
90% of short-term traders lose money. Why do they keep bothering? Why do they? Well, you know, it's a losing game.
Well, most of them actually stop bothering. I mean, and most of them actually get wiped out. I mean, it is a mantra some of the thread building companies use: 90-90-90. 90% of traders lose 90% of their money in 90 days. And it's not surprising, because my new book, Way Trade 2, is all about this particular statistic as well, and what many traders do to cause that effect, because ultimately it's up to the trader himself or herself to deal with that. But most of them don't. Most of them do give up. There's only a few who go on to succeed.
Yeah, I mean, I think it's a universal principle in everything. I don't think it's just in trading. I mean, if you look at businesses, in the first 3 years of businesses, 80% of them fail. For the following 2 years, 80% of the ones that are left fail. You're left with 4%. And I think it's pretty much just a universal law that you'll get 5% of successful people in whatever you look at. So yeah, I think there's no difference with trading to any other business or career path.
I think 90% of short-term traders also lose money because they are in trading for their own reasons, and that's usually the idea that if I go into trading, I make a huge amount of money in zero time, and in my view, it is as any other job. You learn things. So this is one reason, and then it is also the fact that it is the same as every other business. So some people will fail, and the people that will stay will have to have more drive and to be better at it.
They go on because their spouses haven't discovered it yet, so they're allowed to go on. There's very little difference between the performance. If you look at the performance of hedge funds and private investors, and the critical difference when you break it down is this. As a hedge fund, if out of 100 trades we do, we might have 2 big wins. That means months where we might get more than 10%. The vast majority of the other 80% of trades will be small gains and small losses. They'll balance each other out. And that's not just us, it's pretty much every other hedge fund out there in the world. Vast majority of their trades will just be small losses and small wins, with a couple of big wins. You're all used to having big wins, small gains, small losses. So what's the difference between you and a hedge fund? The key difference is we don't have big losses, private investors do. That's what keeps them going. What they do is they say to themselves, yeah, well, if I could just get rid of those couple of big losses, the rest of my performance looks pretty good, and it does. So you keep trying, you keep going, you keep persisting. But actually what you need to focus on is removing those big losses, and then it actually will look like a professional trader's performance sheet. Focus your energies on what it was you were doing when you had those big losses.
Okay, I'll just throw it open to the audience. We've got about 5 minutes before Eve will start. So, any questions?
It's for Alpesh, really. What helped your career move better? Your qualification at Oxford, I believe it is law, or winning incredibly twice consecutive years in national competition in investing?
You're very kind. You mentioned my degrees and competitions that I've won, whereas I kept it to toilet cleaning. We're not related. I'm thankful that you did mention qualification. What helped the most? Actually, again, there's been studies done that people who've studied economics tend to be better at evaluating risk than those who haven't. What we'll tend to do is convert things. You don't have to have studied formally economics, but some understand economics. And I don't mean to understand GDP and PMI and all the sort of boring stuff. You don't actually need to know pretty much any of that. But people who can then assess, as everybody on this panel will do, a probability versus a gain. So saying, well, I think there's a 60% chance, based on past experience, it's going to go up 30 points versus a 50% chance it's going to drop 50 points. Well, what's my risk reward? And they calculate it. They do their expected gain versus expected losses. And that helps. So it's very simple, but economists tend to, and as I say, experiments have been done where they put people in a room and they said, right, here are some dummy trades. And the people who'd had some basic training in working out expected returns, and you can Google expected returns, they were better at it. So that actually helped. I did used to be a barrister, and that really hasn't really, I helped with setting up the hedge fund, of course, because you're dealing with compliance and all the rest of it. But in terms of trading, I guess it was the economics that really made the difference. Funnily enough, it wasn't the degree in politics and all the rest of it, because on most days I don't bother reading the newspapers, and the reason for this is one of the best traders that I know is actually, and these guys will verify that, certainly technical traders, you don't really care what's happening in the news. It's good for general interest, but I don't want to be trying to second guess every single day what's going to happen as a result of something that I've read in the papers, because that's just a lot of hard work and trying to call it right every time. I'd rather use a technical approach, or as I increasingly do, an algorithmic approach, or a statistical approach, rather than trying to understand what's going to happen as a result of the markets. I can get an opinion, but that's not a way I want to formalize trading, because you want to make it as easy and as simple as simpler process as possible.
Yeah. So is it best just to focus on technicals and just technicals or both? Is it best to master just technicals or just combine them together?
It's about your style and your personality. I mean, there are several traders using either or both, and you've got to find the one that's right for you. So I'm afraid there's no easy answer to that, unless anybody else does.
But what's the answer for you?
I use technicals. I think we all use technicals. Thank you.
Yeah, I agree. It is finding what is right for you and what you can then stay with and not move away from if it works for you. For me, it's a combination of technicals and fundamentals, but it can be anything different for someone else.
A couple more, if there's anybody.
How many years?
How many years? How long would it take to get a good trading plan or trading?
It does vary a lot. It's a very individual type question. I'm trying to think really. We have some traders on the course who've got just a year or two, and they're doing very well. I mean, personally, I think probably about 5 or 6, 7 years, that kind of thing. And Cameron.
Well, I suppose, with everything, if you've read the Gladwell book, it takes 10,000 hours to really master something. I second that. But I think, you need a year to just get your feet wet, and the second year you'll get even more wet. And then probably the third year, that's when it could start to turn around for people. But again, it's not so much we measure things with time. It's not really about time as much as it is about effort.
It sounds to me that you could. It takes just as long to be a good trader as it does to be a doctor or a lawyer, and it'd be safer to be a doctor or a lawyer. Is that right? I mean, is it less risk or? So they're comparable things. Okay, last question maybe? Yeah?
Where's the FTSE, what's the highest the FTSE is going to reach before it rolls over? Because it must be ready to roll over fairly soon. Where's it going to roll over and when? It's an easy one for you.
Serious answer?
I'll look at it in my my next report, I think. But I mean, 6950 was the high in 1999. New Year's Eve 1999 was the. So I think that's a key level. I think the case we may have seen the peak already. In fact, we got up to what, about 6, 8? Can't remember now. 6, 8, yeah. I don't think it's going to. If it goes above 7,000, then I would think that's probably be a good time to short it. But I mean, obviously with stops.
I have no problem saying by the end of this year, at some point, it will be, say, 5 to 8% higher. It won't necessarily close 5 to 8% higher than where it is at the moment. And that's the whole bandwagon and the momentum. I'm not saying it's a sensible level, but and then I'd look to reevaluate it for next year. I was speaking to the former head of Goldman Sachs Asset Management, and of course, as well as doing God's work, which they believe they do, they also move a lot of money around. And he said, you know, we'll worry about next year when next year comes. And that's the attitude I take to it, given that you can exit the market at any time. So I'm only going to look at towards the end of this year, and I'm not panicking by any means, but I would increasingly look to pick individual stocks rather than just the index, buy and hold to the end of the year. As I say, things are increasingly getting into the territory that we all deal in, with getting in and out of individual securities, as opposed to just buying and holding, which you could easily do for the last, whatever, 4 or 5 years now.
Okay, thank you to John, Cameron, Maria, and Alpesh. Anybody wants to part with $1 million, open up an account at GNF Capital, become a pro trader or a psychotic trader or whatever you're trying to do at the moment, then you know where to go.